I want to introduce emotional investing. This has its own dozens and dozens of categories, and this is a field of psychology that has really emerged over the last 10-15 years. Emotional investing is really what most people would attribute the disparity between what the indexes have done to what the average investors have done. So in other words, if we look at the last 20 years, the average investor's a couple percent return versus the index is 8-9% return for the most part. Why the disparity? Emotional investing, buying and selling at the wrong times. They're usually using superstition or some preconceived notion or some feeling as opposed to a logical interpretation of data. And the biggest reason I think that people fall into this trap is because the media, which is patterned after a soap opera or after the Roadrunner episodes, it's about entertainment. And it's about exploiting that one piece of data. Out of hundreds of pieces of data, taking one piece of radical data that's going to make news. Here's a $10 billion company with 600,000 employees, and one of their employees does something absolutely terrible, and something bad happens, and of course that all of a sudden becomes newsworthy. Well, the reality is the fundamentals, the earnings of that company that drive the share price are really, over the long term, what's going to dictate the performance of that underlying asset, whether it be a stock or a bond or otherwise. But when we watch the media, because we see the excitement and the animation and the graphs sometimes that they'll pull up that are entirely out of context. And when I say out of context, what I mean by that is, we're taking this company, this supposed index or individual company or investment firm, and we're looking at 1% of the data or one tiny little factor, and we're using that as representative of the entire company as a whole, when such is not the case. If we were to cling on to one piece of data and wanted to use that as being representative, it would be forward earnings and the last 12 months revenue, the debt ratios, a few of the statistical measurements that have no emotional risks to them. There's a filter there that says, okay, we're just looking at the numbers. So as we go through and look at the emotional mistakes, pay attention that we're not going to be sensationalizing the things that we see in the media, the things that would cause us fear. Fear is 2.5 times more powerful than greed, and the media is generally based upon fear because that's what sells. Okay? Fear sells. So as you think about emotional investing and the mistakes that are made there, I want to drive this from one subtopic to the next in these videos to make sure that we are eradicating fear from our financial behavior.